Thus far, we have talked about how cryptocurrency is regulated as money by the states and the Treasury Department's Financial Crimes Enforcement Network, and how it is regulated as a commodity by the Commodity Futures Trading Commission. In this lecture, we will examine the Internal Revenue Service's treatment of cryptocurrency as property. In 2014, the IRS announced that it would treat virtual currencies as property rather than currency under federal tax law. Tax authorities in some states have followed suit and announced that virtual currencies will be treated as property under their state tax laws. Thus, purchases and sales of virtual currency and payments made with virtual currency can be taxable events. So, if you were to buy a cup of coffee with Bitcoin, that would technically be a taxable event, and you would have to pay taxes on the amount that Bitcoin increased by from the time you purchased it to the time you bought your coffee. There is currently a bill circulating in Congress that would change this tax treatment by exempting small gains from certain sales or exchanges of virtual currency from a taxpayer's gross income. While the bill's prospects are uncertain, its passage would make it more viable to use virtual currency as a method of payment for most transactions. Currently, if an investor sells a virtual currency after holding it longer than a year, then the profits under the IRS's classification are typically treated as long-term capital gains, and the tax rate will therefore be 0, 15, or 20%, plus a 3.8% surtax in some cases, depending on the owner's total income. Short-term gains on cryptocurrencies, held a year or less, are typically taxable at higher ordinary income rates. While cryptocurrency does provide a greater degree of anonymity compared to traditional fiat currency, this does not mean that your cryptocurrency transactions will go unnoticed by the IRS. In 2016, the IRS demanded that the largest US-based cryptocurrency exchange, Coinbase, turn over all records pertaining to any U.S. person who conducted transactions in a convertible virtual currency between January 1, 2013 and December 31, 2015. After a year-long lawsuit, the IRS won a judgment that forced Coinbase to turn over account records for more than 14,000 customers. More recently, in January 2018, Coinbase sent 1099-K forms to a number of its current users, informing them that their trading proceeds were being reported to the IRS and reminding them to pay the taxes they owed.